Let us see the next question. X Limited is having a vacant factory. In that, X Limited is considering either manufacturing of a product or to let out the same. So either we do business or we give it on the rent to someone. Details about manufacturing of the product is as under. So details of the manufacturing is given. Purchase price of the machinery is 2 lakhs of rupees. Life of the machinery is 2 years. Straight line method of depreciation is acceptable from tax point of view. Income tax rate is 40%. Discounting rate of cost of capital is 25%. Per unit selling price is 180. Per unit variable cost is 120. Number of units to be sold in the first year 5,000. In second year 6,000. Annual cash fixed cost is 1,20,000. If the vacant factory is let out, annual rental income will be an amount of rupees 20,000. You are required to advise what the company should do. Discounting factor for the first year and second year is provided to us in example. Please go through the question, all of you. Let us have understanding that say how to calculate answer over here. The question is providing the information. The company is considering either manufacturing of a product or to let out the factory premises. Whether the company can do both or not. Very correct. The company cannot do both. The company can either manufacture the product in the factory premises or it can be given on rent. Both are not possible simultaneously. That is the reason technically it is given a name as mutually exclusive options. So technically it is given a name as mutually exclusive options. Either this is possible or this is possible. Both of them are not possible simultaneously. So this is what we understand is a mutually exclusive options. For the purpose of decision making, for this kind of question, we have two approaches. So in examination you can do answer by either of the approach. One is given a name as whole project point of view. The term whole project point of view stands for we make calculation of the NPV for both the options separately. We make the calculation of the NPV for manufacturing of product and at the same time we make the calculation of the NPV for let out option. Between these two, the option which is having higher positive NPV will be selected. This is what we understand is the whole project point of view. Let us say that this is option A and this is option B. Instead of whole project point of view, you can do answer with the incremental approach. In case of incremental approach, we will make the computation of the answer as one option is selected over the other. That is A over B. That is the way we can adopt the incremental approach for decision making. So from examination point of view, both approaches are acceptable. Since it is an initial question, so we will be solving the question by both the methods, from whole project point of view and at the same time let out option. That will answer the question. That will answer first point. In this question, we have been given information about mutually exclusive options. Full stop. Second point, the company can either manufacture the product or otherwise it can let out the factory premises. The company cannot do both. Third point, for this type of question, comma, either we can adopt a whole project point of view for decision making, or B, incremental approach. Full stop. Going with either of the method comma, we will have same decision. Fourth point, in absence of any information about which method to be applied, comma, we can apply either of the method. Full stop. Heading right down, whole project point of view. in the breakdown. Option number 1, manufacture the product. I want all of you to calculate the NPV for option number 1 on your own. We start with the step number 1, investment. Amount of the investment is rupees 2 lakhs. That is in the year 0. That is the purchase price of the machinery. Step number 2, depreciation. Depreciation would be found as cost divided by number of years. What is the cost of the machinery? 2 lakhs. What is the life of machinery? 2 years. So the amount of depreciation is rupees 1 lakh per annum. The question does not provide the scrap value of the machinery, so it is 0. The question is providing the straight line method of depreciation. So directly it will be written off over the time period of 2 years. Step number 3, terminal cash flow. That is 0. We understand that there is neither any working capital recovery nor sale value of the machinery. As the sale value of the machinery is 0, then of course we understand that there is no capital gain or capital loss on sale of machinery. Step number 4, calculation of recurring cash flow. For the first year and second year, we'll make the calculation of the recurring cash flow. So for first year and second year, calculation is supposed to be made like this. We start with the sales value. 180 is the selling price and 5,000 number of units that we are going to produce and sell. So here 180 into 5,000. That comes to 9 lakhs. Variable cost is 120 into 5,000. So friends, the amount of the variable cost will be 6 lakhs. Next is the cash fixed cost. $1,20,000. Depreciation 1,50,000. Profit before tax 9 lakh minus 6 lakhs minus 120 minus 150. So the amount comes to 30,000. Profit before taxes. Income tax rate is 40%. So profit after taxes is 60%. That comes to an amount of 18,000. CF18 is profit after taxes plus depreciation. So it is 18,000 plus 1,50,000. That comes to 1,68,000. This is the way CF80 for the first year can be calculated. I am sorry, the depreciation amount is 1 lakh. So profit before taxes is 80,000. Profit after taxes is 48,000. So the amount of the CF80 would be 48,000 plus 1 lakh. That comes to 1,48,000. That is the way the CFAT for the first year will be found. Whatever we have done for the first year, similarly we have to do it for the second year. Only the number of units are changing. So 180 into 6,000, that comes to 10,80,000. 120 into 6,000, that comes to 7,20,000. Cash fixed cost is 1,20,000. Depreciation is again 1 lakh. So 1080 minus 720 minus 120 minus 1 lakh. So it is 1,40,000 into 0.6, 84,000. 84,000 plus 1 lakh, it is 1,84,000. This is the way the CFAT for the first year and second year can be calculated. Now in step number 5, we'll make the NPV calculation. Step number 5. Calculation of NPV. First year and second year. 1,48,000. 1,84,000. There is no terminal cash flow, so we are ignoring it. Discounting at the rate of 25%. First year factor is 80 paise. Second year factor is 64 paise. Present value 118400. 1,84,000 into 0.64. 1,17,716. So present value of the cash inflow 2,36,116. Amount of investment 2 lakhs. Net present value 36,160. That is the way the NPV of the project can be found. Now let us see the option number 2. Option number 2, let out of factory premises. So let us understand how to make the calculation of answer. We understand it's the step number 1 to step number 3 are not applicable. No investment is required to be made. Second is that no depreciation because we have not made any capital investment. And third, there is no capital, that is the terminal cash flow. Step number 4, recurring cash flow. Again for year 1 and year 2. I am doing it only for the first year, I am not doing for the second year. There will be rental income that we will receive. What is the rental income that we are going to receive? It is an amount of rupees 30,000. That is the rental income. Are there any expenses? No, there are no other expenses. So profit before taxes is 30,000. What is income tax rate? Only 40%. So profit after taxes is 60%. That comes to 18,000. Is there any non-cash item to be adjusted? No. So we understand that say whatever is the profit after taxes itself is cash flow. That is the reason the recurring cash flow I am computing only for the first year. Step number 5. In that calculation of net present value. So let us see that's how to make the NPV calculation. Let us see NPV calculation. first year and second year. As far as the first year cash flow is concerned, it is 18,000. We know that doing it for the second year does not make a sense, because the second year cash flow is going to be the same as the first year. So I am discounting with the present value factor at the rate of 25%. First year factor is 80 paise, second year factor is 64 paise. Present value is 14,400, 11,520. Present value of the cash flow, it is 25920. What is the amount of the investment? No investment is there. So what is the NPV of the project? 25920. In a way that if at all, we let out the factory premises, the NPV is 25920. This is the way you can present the answer, or otherwise we may present the answer slightly differently. In a way that as we were doing a kind of questions like this in our school time, x into a plus x into b, then x can be taken as common in bracket a plus b. This is the way we can keep the equation. So what will happen, friends, over here? Year 1 and year 2 cash flow is common, 18,000. Now instead of multiplying with the respective year discounting factor, a smart student like you can work out the answer like this. You can make the summation of the first and second year factor, that comes to 1 rupee 44 paise. 18,000 into 1.44, that is the way the present value can be found, 25920. So this is what we understand is the present value of the cash inflow, 25920. What is the amount of the investment? Is 0 once again, and that is the way we can compute the NPV. Yeah, NPV of the project would be 25920. So you can have either of the presentation of the answer. This is the way the individual year, or you can have the summation of the discounting factors, the years for which the cash flows are same. Dear students, sometimes the question is providing the even 10 years time period. Then in that case, going individually becomes very time consuming. So better to go with the cumulative factors, and with that we can make the calculation of the NPV. Please take down answer. So the written answer, based on above calculations, comma, we can draw following conclusion. The first option is manufacturing, the second option is let out, NPV 25920, and 36160. So we go for the first option, manufacturing. So let us revise the answer. The first option is manufacturing of the product, investment 2 lakhs, depreciation 1 lakh per annum, terminal cash flow 0, recurring cash flow for the first year 148, for second year 184. NPV is calculated by discounting the future cash flows in the present value term. Second option is let out of the factory premises. First 3 steps are not applicable. First year cash flow is an amount of 18,000. It is discounted in present value term for NPV calculation. The presentation of the answer can be made differently. You make a comparison of both NPVs and you select the option which is having higher positive NPV. The next is the incremental approach. Now friends, as far as the incremental approach is concerned, you can adopt like manufacturing over let out, or you may adopt reverse, let out over manufacturing. In a way that say you can have either of the approach for the purpose of decision making. Either of the approach can be adopted for the purpose of decision making. Generally my suggestion is that say you have an approach of manufacturing over let out. That is what's the kind of say suggestion which I have. In a way that say let us do business over not doing business. That is an approach which I suggest for the purpose of decision making. Doing reverse is also acceptable, and even in that case you would be able to get the answer. But generally my suggestion is that say the manufacturing over let out. In that case, how to make the calculation of answer, let us discuss. Everybody is requested to start writing an answer along with me. Incremental approach is adopted as one option is selected over the other. Full stop. Usually we will adopt incremental approach as manufacturing over let out. It means that let us do business over not doing business. Yes. Step number 1, investment. Manufacturing and let out. We understand that in case of the manufacturing, investment is 1 lakh, investment is 2 lakhs. And in case of let out it is 0, so the incremental investment is 2 lakhs. Step number 2, depreciation. Manufacturing and let out. In case of the manufacturing, the depreciation is 1 lakh rupee per annum. In case of let out, it is 0. Step number 3, terminal cash flow. It is 0. In a way that say the first 3 steps are once again very simple. Step number 4, the recurring cash flow. As far as the recurring cash flow is concerned, it can be calculated by 2 methods. Method number 1. Let us understand that in first method how we can do answer. First year and second year. We will start with the sales value. 5,000 number of units into 180. So sales value is 9 lakhs. Variable cost 5,000 number of units into 120. That comes to 6 lakhs. Cash fixed cost 1,20,000. Till this point of time, everything is same what we already have done, along with the depreciation. Now friends, what happens at say, if at all you do business, then in that case you forgo an opportunity to receive the rental income. So here friends, we will mention rental income forgone. And in technical language, so this is given a name as opportunity cost. That is an amount of 30,000. And based on that, so the PBT is found. So 9 lakhs minus 6 lakhs minus 120 minus 1 lakh minus 30,000. So you get profit before taxes is 50,000. Tax rate is 40%. So profit after taxes is 60%. That comes to 30,000. Add back depreciation. Why? Because it is a non-cash item. So we get CFAT 1,30,000. So it is 30,000 plus 1 lakh. So this is the way you can make the computation of the CFAT for first year. Friends, the second method is quite simple method. When you make the computation of the CFAT, if at all you manufacture, that is 148. And CFAT, if at all you do not manufacture, that is 18. It means that say by manufacturing of the product, what you receive 148. And in case of the let out, what you could have received 18,000. And difference of both of them can be calculated, and that is what we understand is the incremental cash flow for first year. This is the way the method number 2 is there. Method number 2 is the method in which you make the computation of the separate cash flows for the each of the option, and then you compute the difference. Try to do the incremental cash flow for the second year on your own. Number of sales units in the second year is 6,000. Selling price is 180. So it is 10,80,000. Variable cost is 6,000 into 120. $7,20,000. Cash fixed cost 1,20,000. Depreciation 1 lakh. Again the rental income forgone opportunity cost is 30,000. So profit before taxes 10,80,000 minus 720 minus 120 minus 1 lakh minus 30,000. So 1,10,000. Minus 40% of tax 66,000. So cash flow after taxes is 66,000 plus 1 lakh. That comes to 1,66,000. Again that you can cross verify. It is 1,84,000 minus 18,000. This is the way the CFAT for the second year can be calculated. Now after doing method number 1, I am doing method number 2. Method number 2 is like you prepare a detailed table for manufacturing, then you compare the same with the let out. With the detailed table, of course, we will get 148 and this is 18. So the differential or incremental is 1,30,000. This is for the first year. Similarly for second year. Manufacturing and let out. With the detailed table you get 184. Again with the detailed table you get 18 and differential is 166. So this is the way the differential cash flow is found for the first year and second year. Step number 5. Calculation of net present value. First year and second year, Cash inflow is 130 and 166. This will be discounted at K cost of capital 25%. First year factor is 60 paise, 80 paise, second year is 64 paise. Present value 104 I think. Then 166 into 0.64. 106 240. Present value of the cash inflow 2,10,240. Less investment 2 lakhs. That is the way the NPV is found 10,240. Now whatever the NPV that say we have found is positive NPV. So we understand that say when you have the positive NPV, then in that case the option which has been taken as a base for preparing the incremental cash flow series will be selected. That is manufacturing over let out. If NPV is positive, then in that case we will select the manufacturing, and suppose it would have been negative, then in that case we would have selected let out in a way that say the manufacturing is not as good as let out. Whatever the answer that say we have calculated over here, that can definitely be cross verified. 36160 minus 25920. You can see that the difference between both of them is 10,240. That is what say we understand is the difference between both of them, and we can say that say whatever this difference that we have itself is the incremental NPV that say we are going to get later on. That is over here 36160 minus 25920. Friends, this is a very basic and a very simple question where we can cross verify the answer. Every time such cross verification would not be possible. So just have an understanding that say always the incremental approach is going to give you say the correct decision. This is what we understand. Chalo, please write an answer. The company is advised to manufacture the product. Full stop.